Hi everyone, this is Kendrick Nguyen. We're going to hold for 1 minute and we'll start the webinar exactly at 2. Good afternoon, everyone. Thank you for joining today's webinar hosted by the U.S. Pan Asian American Chamber of Commerce as part of its Business Leadership Series. The topic of today's webinar is Startup Fundraising. My name is Kendrick Nguyen, and I have the honor of moderating today's conversation with two legendary entrepreneurs, Holly Liu, visiting partners at Y Combinator and co-founder of Kabam, a leading mobile gaming company with annual revenue in the hundreds of millions of dollars, and Patrick, co-founder of Rotten Tomatoes, the popular movie review platform that we all know about, and it has over 20 million unique visitors each month. I can't wait to hear from Holly and Patrick the story behind Kabam and Rotten Tomatoes, how they fundraised and built their visions into companies that are now household brand, and particularly lessons, advice, and tips on the topic of startup financing. First, allow me to start with a short introduction of myself and go over various financing options available to a new or an early stage business. I'm currently CEO of Republic, which is an investment crowdfunding platform that allows people of any net worth, from students to millionaires, to invest in startups that we have curated. Republic has raised from about a dozen VCs, and more than 100 entrepreneurs have successfully raised on Republic since we launched in the summer of 2016. Most of the companies on Republic are tech startups that are venture backable, but not all. From drones to cannabis to ice cream brands, you can see the wide range of startups fundraising from the crowd on our platform at republic.co, that is .co. Now, crowd investing or fundraising on Republic is suitable for certain types of businesses, mainly consumer facing, but not all. And the same with raising from venture capital, that's not for everyone. So let me touch on the range of fundraising options that an entrepreneur should consider. Two things when it comes to raising capital that you gotta balance, and that's the loss of control and the value that comes with capital. Say capital that is just money with no value add is probably from grant, bootstrapping, startup competition, and then friends and family already, provide more and more value to your vision of building that business, and you have a lot of control for bootstrapped capital or friends and family capital. On the other side, and almost the opposite spectrum, for example, venture financing is tremendously value add, because you bring the wisdom, the experience of the venture capitalists who deploy capital into your company and guide you along. For example, Holly as a partner at Y Combinator and her wealth of experience, should you receive an investment from Holly, you also get that knowledge in addition to just cash. And on that end, VC capital, you do lose some control, meaning there's going to be a board. Your VC investor will be, will have a say on how you grow your business. The maximal loss of control, of course, is toward probably the IPO or ICO if you go that route nowadays. So the range of financing options can be from startup competition to grant, friends and family, crowd capital, crowd donation like Kickstarter. You have accelerators and incubator. You have private equity, VC, depending on how large your company may be. You have debt financing. Go to a bank and get a line of capital, of loan, and obviously the IPO and ICO. But for today's discussion, in the interest of time, we're focusing on early stage startups and on primarily two main options that are very relevant to a range of business. That is bootstrapping, and that's relevant to any business, any new business, quite frankly. And the second piece is how to raise from VC, which is more pertinent to scalable companies or companies that can potentially realize, many fold in returns due to the addressable market of their business. So without further ado, allow me to turn it over to Patrick, co-founder of Rotten Tomatoes, to share his story and perhaps touch on bootstrapping to fundraise and build a business.
Great, thanks, Kendrick. So my talk is targeted towards first-time entrepreneurs looking to raise funding. Some personal background: I went to UC Berkeley. I did 6 different startups, the best well-known of which was Rotten Tomatoes. On the fundraising side, I'm all over the place in terms of my different companies. The first company, we self-funded it with just money we had in savings. The second one was a design firm, and we got a $30,000 loan from our family. The third one was Rotten Tomatoes, and we raised $1 million from angels as well as one small VC. The third one was a company in China. We raised $1.3 million from angels and actually family members, and I don't recommend raising money from family members. The fifth one was a company in Hong Kong, raised $500,000 from strategic angels. And the most recent one I was doing was a gaming company in the Bay Area, where we raised $5 million from 2 venture capital funds and strategic angels. Next slide. So if you are a first-time entrepreneur with just an idea or prototype, my recommendation is don't bother to try raising money at that point. And why is that? Well, basically, fundraising is a full-time job. It usually takes you about 3 to 6 months to raise money. And the time you're spending fundraising is time you're not spending on growing your company. 99% of the people you talk to are going to tell you no. And after hearing too many no's and having flat growth since you're not focused on your company, in many cases you get demoralized and quit. And even if you don't quit, the flat growth makes it almost impossible to fundraise. So what should you do instead? Next slide. Bootstrap. The goal of bootstrapping is to keep your costs as low as possible. One way to do that is obviously minimize expenses. So don't take salary, or take the absolute minimum to survive, or have a job and work on your idea on nights and weekends. Don't get an office space. Don't worry about legal, finance, patents, etc. If the idea doesn't work, then there's no point in doing all these things. Remember, you can always cut costs, but you can't as easily increase revenue early on. So with Rotten Tomatoes, we were forced to bootstrap. We raised $1 million in January 2000. The internet stock bubble burst 2 months later. We had to cut from 20-something people to 21, 17, 14, 11, and finally down to 7. Everyone took at least a 30% pay cut. 2 of us, myself and our marketing person, went to 0 salary, and I had to sleep under my desk for 6 months in order to save on rent. Another way to keep your costs low is to get technical. It's great if you have a technical background and can code yourself, because otherwise, if you can't, you usually end up having to hire a contractor, which is a big waste of time and money. If you can't code, you either need to learn or recruit a technical co-founder. And it's really hard to recruit at an early stage. And if you don't have someone at the top of your head, it's as hard as fundraising. The third thing is to try and keep it simple. I'm sure you've all heard of minimum viable product. Basically trying to get out the simplest version of your product where you can actually test to see if it's working or not. Remember, less is more. You know, a lot of times companies, when they first start out, try to hit too many markets, too many categories, too many features. But when you look at companies such as Facebook, initially they just were in Harvard. They weren't anywhere else. And then gradually they expanded to more and more markets. Amazon was just books in the beginning. And when you talk about companies that there's plenty of startups that just look like features. Rotten Tomatoes, we only did movie reviews. Instagram, Twitter, YouTube. They're essentially like one main feature. Next slide. So what you should do, you should focus. The goal of focusing is to keep your time as short as possible. One way to do that is to cut out busy work. So there are many ways that you can be busy working on your company, answering email, researching, customer interviews, fundraising, working on your PowerPoint presentation, business plan, figuring out your company name and logo, finding office space, setting up legal or finance, writing a patent, etc. These are all a waste of time. I actually want to expand more on researching. My personal philosophy is you should spend maximum 1 week on researching and no more. Otherwise, you're going to convince yourself not to do it. Any idea you have, someone has done something basically at least 95% the same. And what's going to happen is they generally fall into two categories. Either they're very big and you get scared of them and then decide not to do it, or they tried your idea and it didn't work and they're dead. And so you decide, okay, it must have been a bad idea. You know, if you look at Google, for instance, in search, when they started, they could have easily looked at Yahoo and decide not to do it, or they could have looked at Excite, which was dead at the time. Similarly with Facebook, they could have looked at MySpace when they were starting, and MySpace was huge at the time, or they could have said, look at Friendster, and Friendster was also dead at that time. What you should be doing by focusing is you should be trying to answer one question. Do people want this? Basically trying to look for product market fit. Going back to minimum viable product, one example was a company called Ideal Labs. They wanted to know early on in the internet if people would actually buy cars online. So what they did was they built a website to sell cars. But they didn't actually create any of the infrastructure behind it. They didn't actually cut deals with dealerships, figure out distribution, anything like that. They just built a website, advertised it to see if people would actually come on and buy a car sight unseen. And then when people bought it, they just went and ordered the car and had it shipped over, even though they might be taking a loss at that time. So how can you do something similar? Well, one way is to make a landing page for your idea, buy some Facebook ads, and see if people actually sign up. You don't actually have to build the product. You just have to kind of get it out there and see if people want it. Another example is with Kickstarter. If you're doing hardware, for instance, you could make a video on Kickstarter, pitch it out, buy some ads against it, and see if people actually go in and fund it. Another thing that you can do is to look for some kernel of product market fit. You don't actually have to build the whole thing and get perfect product market fit. But if you can get something that kind of shows like, hey, this is going in the right direction, people do seem to want this. So with Rotten Tomatoes, early on when we launched it, when Pixar released A Bug's Life, we saw a spike in traffic. And when we looked into it, it turned out it was actually coming from Pixar. Another time, there was a magazine that came out where Roger Ebert, a famous film critic, had written an article highlighting his favorite 20 film sites, and Rotten Tomatoes was one of them. So that's when we decided, hey, we should maybe think about doing this as a business and raise money if Pixar and Roger Ebert were using our site. And that happened within the first year of launching it. Another way to kind of tell if people want your product or not is to look for traction. So that could be through traffic. For instance, how many users are using your app or coming to your website. It could be through engagement and retention. How long are they using your product? How often are they coming back? It could be through revenue. If people are actually spending money buying your product or hiring you or whatever. One way to kind of work on getting towards traction is to figure out the single most important metric for your business. So for example, for a marketplace play, it might be transactions. getting in buyers and sellers in your marketplace to actually transact with one another. For Rotten Tomatoes, the most important metric for us early on was page views. When you set that metric, spend all of your time trying to get that number up. So you can set goals tied to that metric. For instance, if it was transactions, you might be like, we're going to try and get 10 transactions per day by month 1, 100 per day by month 3, 1,000 per day by month 6. Remember, product market fit beats everything. It beats having a great team, a great idea, great technology, great market size, a great presentation or business plan or pitch, patents, everything. If it's actually, product market fit proves that it's working. And that's what you want to be focusing all your efforts on. Next slide. Actually, I think that's out of order. But so when do you want to fundraise? Well, if you focus, it doesn't take too long. You look at Y Combinator and 500 Startups, those are 3-month programs. And yeah, they pitch at demo day, but the majority of the pitch is about the numbers. So if you focus, you should pretty much have a good idea within 3 to 6 months if your idea is working or not. And this is the same amount of time that you typically would need to fundraise. If you bootstrap, you don't need that much money. 6 months of rent, say $3,000 a month, that's $18,000. 6 months of food, say $10 a day, that's $1,800. That's less than $20,000 in total. If you can show product market fit, then you can fundraise. If you can't, and your growth is flat or declining, then you should consider pivoting to a new idea. So how to fundraise? Well, like Holly's going to probably talk a lot more about this, but some quick tips: develop your network. Build your network before you need to raise money. Don't ask for money the first time you meet an angel. Get advice instead and develop a relationship. When you actually do fundraise, time your attack. Set up your pitches close together to create a sense of urgency. And when you actually are raising, try and find the lead. Focus on getting one angel or one VC to act as the lead. Ideally, this should be the most strategic investor on your list that you already have a good relationship with. A good lead investor will make it very easy to close others. Next slide. Finally, I want to give a quick analogy to help you kind of try and understand better what I'm talking about. So running a startup is a lot like playing poker. Poker is a game of luck and skill. On the luck side, the cards are random. On the skill side, when you look at poker players, the best players win consistently over time. So think of startups as a game of poker. On the luck side, your ideas are essentially random, and your idea is your starting hand. On the skill side, the execution still makes a huge difference. How do you play your hand? So when you look at poker strategy, it's basically a 2x2 matrix. On one end, you can be tight versus loose. A tight player, for instance, folds often and waits for a good hand. To a loose player, everything looks like a good hand. And on the other side of the matrix, you got passive versus aggressive play style. A passive player tends to check, and when someone bets against them, they just call. An aggressive player tends to bet, and when someone bets against them, they will raise them. So if you take this 2x2 matrix, you get 4 types of player: a tight passive player, a tight aggressive player, a loose passive player, and a loose aggressive player. Generally, the optimal play is tight aggressive. So if we take that back towards your startup, when you think about it, it's for tight, that means testing your ideas quickly and cheaply. Fold immediately if they don't work, meaning pivot. And then wait until you find something that works, meaning you found product market fit. And then aggressive is once you've found something that works, then you raise money, scale up, and go big. Next slide. So in summary, when you're starting out a startup for the first-time entrepreneur, generally you should be bootstrapping, which is keeping your costs as low as possible. You should focus and keep your time as short as possible. Product market fit is the only thing that matters in this situation. And then once you have found product market fit, then look at fundraising. That's it. Thank you.
Thank you so much for that, Patrick. Super helpful, incredibly insightful. Holly, if you don't mind, would love to hear your stories and perspectives.
Yeah, not a problem. Patrick, that's a hard thing to follow up on. I'm going to start just by talking a little bit about Kabam and then weaving through kind of the flip side of it. Patrick has a ton of experience on bootstrapping. On our end, we pretty much fundraised from the beginning. So Kabam, for those of you who don't know, we're a mobile gaming company. Basically, we didn't start out that way, and I'll go through some of the history, but what we're best known for is taking Hollywood IP such as Marvel, Marvel, putting it into a game such as Contest of Champions, as well as things like Fast and Furious, as well as Star Wars. Can you go to the next slide? We started in 2006 and we became a global gaming company, and we sold in 2017. And I'll walk a little bit closer through some of just where we ended up fundraising along the way. So we had about 6 offices worldwide with 1,500 employees. We had studios in San Francisco, Vancouver, Beijing, and Los Angeles. And by studio, we usually mean where they made the games and where they made basically where they made the games. At our height, we were about 1,500 employees. That included contractors as well. Can you go to the next slide? We ended up, these are just a swath of folks that we partnered with, and then we had investors from all over, from investors from Google Ventures, so it's Silicon Valley money, to the movie studios, which were strategic partners, along with global strategic partners such as Alibaba. And I'm happy to kind of walk through some of the impact of this. Can you go to the next slide? Oh, so this is our co-founding team. So many of the things that Patrick talked about is very, very true about fundraising. So the whole idea about you really don't want to fundraise in some ways. Like if you can have a business that didn't have to require outside capital, I think that that's not a bad thing to go. But there are some businesses that require outside capital, such as Uber or Lyft or some big, like WeWork. I think it'd be hard to buy up a whole bunch of those real estate, like the property, unless you already were independently wealthy and rich. So if you are not making any money, you should be living in a bootstrap mode. What does that mean? That means you should be keeping your costs as low as possible until you can get that revenue in. And this is really true with consumer companies. Patrick and I probably have more experience in consumer companies. Enterprise companies might be a little bit different. I've seen some companies grow really big by what they call investing the dollar into sales and selling that. But all of Patrick's tips on bootstrapping, just pretend you're bootstrapping. So this was our first office. We had about $500K in seed funding from a venture capitalist firm called Canaan. And I think once you raise money from a venture capitalist, the expectation is you're going to become a $1 billion business. And that is the hope. We all know that the percentage-wise is very low. So the venture capitalists are all playing the odds on whether or not their company, like whether or not a company that they've invested in will return what they call their fund. So if you ever think about raising money from venture capitalists, you should certainly learn how venture capitalists are set up and how they make money and how they stay in business. There's a really good book called Venture Deals that you might want to consider looking into. And it talks a lot about like how is it that venture capitalists get paid and how do they make money. That you will find kind of enlightening and realizing that you're just one of the many bets, if you're on the startup side, that they're taking on you. And at some point, if you're not becoming that $1 billion startup for them, they probably pretty much are not going to spend as much time on you or even put you into kind of really even put money into you guys. So some examples where you might hear that it's not venture backable will be things like washing machines or restaurants or even movie theaters. These types of businesses are really great small businesses, but it's really hard to quote unquote scale. And this is why venture capitalists really like technology. So with technology, if you think about something like Facebook, you could write one line of code and touch 2 billion people at once. That means it has high leverage. So you just put one person on one thing and you can get huge, massive returns. So that's really something where you want to think about, is your business going to be kind of what we call a venture backable business? Don't get me wrong, there's other types of businesses like food and beverage, and those are different types of capital that you can raise. I will put a plug in for the Republic here, where it seems like they have from all variations of any type of business, and those are pretty good. But the ones where you go for VCs and you fundraise are incredibly important. So let me walk through a bit of the timeline of Kabam and how it came to be with a little bit of the background. Can you go to the next slide? So just a couple of quick facts. We started out as Water Cooler, and we were making a corporate social network. So Facebook was incredibly big at the time, and we said, look, the people who are on Facebook, they're just selling like this to students, people who don't have any money, right? Why don't we have a corporate social network for professionals, almost like LinkedIn, but internally? So with that, we raised some seed money, and I will put in a huge plug for what Patrick said. Is it was really off the backs of our CEO's network, because he was in venture capital before as well. So it's incredibly important if you're thinking about fundraising to certainly warm up some networks before you even need the money. In 2007, so after about 8 months of working on this corporate social network and 3 iterations later, we only had about 1,400 users, of which maybe only 5 were active. We had a bunch of cease and desist letters. A lot of things were, I guess, probably a bit more assertive in marketing to people. So about that time, we were actually considering whether or not to close our doors or raise another round, or not raise another round, but close our doors or try to pivot into something else. At the time, we had so little money left that our seed funder was like, you know what, it's not even worth the write-off. You should consider going onto Facebook, because that was the biggest thing we were thinking about moving into. They have launched their developer platform where anybody can just develop off of there. And at that time, they had a bunch of users. And I think one of the things we learned is we needed to go to where the users were. We needed to go and find product market fit as quickly as possible. And that goes back to kind of what Patrick was saying, is it's all about product market fit. The thing with fundraising is that, you're under an extreme amount of pressure to find that product market fit. Because if you're not growing as fast as possible, after a while, venture capitalists will basically go and tell them, we'll think that this company doesn't have the momentum, and we'll end up, quote unquote, like, I guess what we call just dying. So so venture capitalists will want kind of that speed and that momentum. So we went to Facebook looking for product market fit as quickly as possible. We found it by doing it TV shows and sports communities. In 2000, by the end of it, we had millions of users, over 30 million active users, 600 communities, and we were able to raise our Series A off of that because we were ad supported. So we were making several millions in ad base. But in 2008, the recession hit. And this is the time where we had just started raising our Series B, and term sheets were signed. But the day that money was supposed to get wired in was the day that Lehman Brothers crashed, and there was no money that was wired in. So we saw $3 million contracts disappear overnight. We just were not able to figure the next thing out. So again, we were under a ton of pressure because now we've raised a Series A. We didn't know what to do next. So we looked around the market and we said, you know what is getting traction already? So we were under a ton of pressure to see what was getting traction. We were a bit more market driven. So what we did was we said, look, we know how to make Facebook apps. Between all of us, we had about 100 years of Facebook experience. On top of that, our CEO loved games. Zynga was killing it. So we're like, hey, maybe we could do something like this as well, when we took it into a different platform. So at that point, we probably ended up raising our toughest Series B ever. It closed in October. And it was just probably a couple million, maybe yeah, I can't remember what the valuation was or how much we raised, but it was just something that was something really hard. And this was something we learned about fundraising for us personally, that it was much more dependent on outside kind of conditions than how well we were killing it. So at the time, what we learned is with the recession, it really impacted us and we had no control off of it. As much as like Patrick likens the kind of example to playing poker, I liken fundraising a lot to almost like surfing in many ways. So it's almost like, what are the macro conditions that are happening? If it's like a recession, it's going to be incredibly hard. Like there's just not going to be any waves in the ocean. The next question is like, how are the waves at the beach that you want to surf at? Meaning like, what's it like in your industry? Are there any waves in the industry? Like currently, maybe the meal kit industry is under a lot of problems. For us, we've been finding like for mobile gaming, there were times where there was ebbs and flows, and I'll go into where it was riding really high for us, and we were able to close one of our rounds within a week. That's how good it was. And then there were times where it was just so tough. And then finally, the last thing about being similar to surfing is when you see that wave, can you recognize, can you as a company get on that board and catch that wave? And that's 100% in your control. It's a lot of practicing. It's a lot of seeing different things and trying to get not only what to get to that product market fit. How do you manage your player base or your user base? How do you start growing an organization that can help grow that product? Can you go to the next slide? So in 2010, this was our fastest raise ever. Our Series C, we raised 30 million within a week. The reason why, what was happening was Zynga was going for one of the largest IPOs for mobile gaming, and it was, or sorry, not mobile gaming, but for Facebook gaming. They had grown so quickly. It was a new platform. On top of that, for gaming itself, in the industry, it was a new model. It was games as a service. It wasn't something where you had to pay in advance. You could play the game for free, and then you could pay money. The player could decide to play money for premium experiences. And that was an incredibly new business model for our industry. So once we raised our Series C, we brought in more what we call institutional money from VCs. So it was able to get like a little bit more partners at that point. And that was our fastest raise ever because Zynga was killing it. They were looking for the next, all the investors who missed out on Zynga were saying like, which other company is like this, and that we can go ride on the coattails on. Because a lot of things, sadly, with investor sentiment is a lot of tailwinds. I will say that you could spend a ton of your time being distracted by fundraising and not building a real company. Fundraising is not a real company, and I'll just throw that in there. I'll probably come back to that again later. So in 2011, we raised another round, 85 million, and we moved into mobile gaming. In this round, we brought more strategic partners such as WB and GM. You will find this pretty similar of this road of when you do later investments or later fund, or like older VC-backed companies. As they get to later rounds, you look for more strategic partners. You should always be looking for strategic partners. They should be able to add value. You should really, really think hard because every single time that you sell a piece of your company, you're losing what Kendrick would call control or ownership, right? So we'll talk a little bit about ownership and we'll talk about dilution. So in 2014, we went on to raise 120 million Series E from Alibaba. And at that point, we were valued at $1 billion. Now, being valued at $1 billion doesn't mean that somebody paid $1 billion for you, but they did pay for that percentage of your company to get a piece of that company. So it's some proxy to it, but you still ultimately, for any type of startup, you have to consider what they call an exit. And when you get into fundraising for VCs, you lose a lot of control in thinking about what kind of exit that you want or need to have. For a lot of venture-backed companies, they're looking for that $1 billion exit, and if you can't get to that, then it's incredibly difficult and a bit strenuous on the founder. It's almost like, you know what, you are becoming an Olympic skater, and that's the only thing you're going to do, and you will not stop until you get gold, type of thing. So, but there's all these markers along the way. So at this point, for us, we realized that it might be the best time to sell our company. Mobile gaming was consolidating. The founders were getting tired. And I will throw out, it's probably very rare that the founders, most of the founders except for one stayed for this full time. We ended up splitting up the company and selling it to pieces. The first largest chunk was sold for about 800 million into Netmarble, and then the rest was sold to Fox Next, which totaled between 1 to 2 billion. We raised over $245 million, and I will say for any venture-backed company, if you talk to a founder again, they'll probably say that was too much money we raised. And I'll tell you why, because every single dollar that you raise, you end up losing. You could go from 30% ownership all the way down to 3% ownership. Now, the concept is, though, is you will be raising money to capture a bigger piece of the pie, and there's a bigger pie out there. So if you go to the next slide, I will end it on this type of kind of bring it full circle. What Kendrick was talking about is that we fell into the quadrant of the top one, rich. And by rich, so this is basically done by Noam Wasserman called The Founder's Dilemma. It's a book. I recommend anybody who's thinking about becoming a founder to take a look at this. And really the question that they have is, do you want to be rich or king? I think rich is a little bit misleading in that, like, how much value do you want to build is really that question, because oftentimes you can make an argument that you could bootstrap your company, sell it for 100 million, own a lot bigger piece of the pie, and you yourself get rich. But there's no way you could build overall value, as much value, without probably fundraising. So we ended up in the rich category, mainly because usually companies like that, they raise a lot of money so they can hire the best talent, so they can grow as fast as possible and build value for the entire shareholder base, as much value as possible, and try to get to those billion-dollar exits. The lower left quadrant is key. So these probably tend to be more bootstrap companies. There was a bootstrap company called Grasshopper, which was, the co-founders were just two of them. They owned pretty much 50-50. They sold for 200 million. So the guy walked away with $100 million in his pocket, thereabouts. And they were able to grow that company completely bootstrapped. They never took a drop of VC funding. So, but they had complete control. And that was the thing. If you listen to their story, that's what they wanted. They wanted ownership and control. So it's almost like ownership is probably a better proxy for the word king. Now, this book is a really great book, because if you try to do both, mathematically, you probably end up failing. So you should choose one category or the other and completely focus on it. Though there are exceptions where you could be rich and king. Those are probably the Facebooks and the Googles. So those are pretty, it might be pretty hard. Some bootstrapped examples will be this woman created Epic, which is an electronic health record form, and they're about a $3 billion company. So there's probably some examples that land in both. But if you try to do both mathematically, your probability is you'll fail. So that's a little bit of where I'll stop right here. I'm more than happy to talk a little bit more on fundraising and thinking a bit more on those pieces. But together, those are kind of a bit our stories.
Thank you so much, Holly, for the incredibly invaluable insight. And you touch on the need to do due diligence to understand what VC or how VCs are optimizing or monetizing to make the process more efficient. And I cannot agree more. I mean, often I've spoken to founders who knock on all the wrong doors. If both of you, Holly and Patrick, if you can share, knowing what you know now, what is one thing that you would have done differently on your fundraising journey? And on that note, I want to encourage all the attendees listening in. If you have questions for Patrick, Holly, or myself, just post them in the chat room below. And I'll take them in turn. But yes, Patrick and Holly, knowing what you know now, what is one thing that you would have done differently on your fundraising journey?
For me, I think that with my fourth company, I mentioned that I had raised money from family members in addition to angels. And I think going back, I would have not have raised from family. They had actually approached me because we had sold Rotten Tomatoes, and they were like, why didn't you let us invest in Rotten Tomatoes? So I let them invest in my next one. But then the next one didn't go well, and it caused problems with family members where they weren't strategic and they didn't really totally understand the risks involved. So going back, I think I would not have done that. Loan from family was okay because we paid it back, but raising money was a different story.
Interesting. Super helpful. Holly?
I wish we would have raised $100 million less, but like hindsight's 2020. It would have been everything in general was touch and go, and you'll probably find that with any company, as it's just so many like twists and turns. Like, who would have thought we would have been able to sell for what we did? But I wish we wouldn't have raised. I wish we would have raised about 100 million less.
Wow.
I don't know.
This is a good problem to have. Now, there are so many VCs out there, particularly nowadays, micro VCs and larger VCs of all different verticals, many of which are sector agnostic and some are very specific. If one were to decide to pursue venture backing, how do you go about finding the right VCs that are strategic and supportive, hopefully, to you in the future?
Sure, I'll take this one. So it depends where stage you're at. So we certainly didn't talk a little bit about the stages of fundraising. So there's pre-seed and friends and family round, which Patrick talked a little bit about when he raised his fourth startup. And some people come in with that to try to get the product market fit. And when I say come in, the next stage is what we call seed funding. Ideally, like about 5 to 7 years ago, seed funding was the first money in, but now it's become much more what we call institutionalized, meaning that there's people who actually raise funds for this, and they basically go and have bosses and think about how do I programmatically be the first money into these companies. And this is really kind of pioneered by Y Combinator, the accelerator model. So they really view themselves as investing in batches. And this is one thing, if you're looking for first money in, you should definitely consider some of the accelerator programs that are out there. I would definitely look at all the alumni that come out of there and see what's the best fit for you in terms of like companies which they come out. Like Alchemist does a really good job with SaaS and enterprise. Y Combinator has done quite well with both. We have like Dropbox and Stripe. And then we also have consumer ones like Twitch, as well as Airbnb. Those are all birthed out of Y Combinator. And just for those who don't know what an accelerator program is, that you apply, and we aim to be the first VC money in. If you are accepted into the program, we give you $150,000 in exchange for 7% of your company. And then there's a 3-month program where we focus on helping you build your company. And after 3 months, we put you on stage and with about a 2-minute pitch to investors. And basically for any founder thinking about raising seed money, it's probably one of the easiest ways to have your best shot at it because all the investors are there at once. When we started our company, there was none of these like type of accelerated programs. So we ourselves had to go door knocking and building momentum. Strangest thing about fundraising is it's like a own separate game that's related to your company, but fundraising is not company building. As Patrick said, it's so true. It takes 3 to 6 months to fundraise for your company, and during that time, you're completely distracted on things that aren't really your company. So I certainly think that is something that's quite like it's something where you have to deal towards those expectations. And then once you get into seed. Once you get seed money, it's about every 12 to 18 months. We're looking for certain type of milestones and expecting some type of fundraise. So that is something that's a bit of a different ball game. So once you get your seed money, we're asking, okay, so a lot of founders ask me, how much money should I be raising? We usually say, go back to your kind of fundraising plan. What is it that you need to hit certain milestones? For enterprise, it's usually about $1 million in annual recurring revenue. And how do you get to it in 12 to 18 months? What is it that you need? How much money does that cost? That's usually your fundraising plan. That is what you need. That's for the seed money, the seed phase to get to Series A, and then Series B has different metrics, as well as Series C and Series D. So like Series B is usually, you need to know your unit economics a lot, meaning like how much money does it cost to acquire a customer? How much is the LTV? If you were to put another dollar in to expand into another geography or whatnot, what will it look like? But knowing your unit economics will be incredibly important by the time you want to go for your Series B. And then Series C is usually around expansion. Series D is probably around strategic partners at that point. So at every phase, there's different kind of milestone markers that you're looking for to build your business on. I'm not sure if I answered your question though.
Definitely. I think
Okay.
it's very important to lay out that roadmap. How do you think the fundraising environment has changed in the past 5 to 10 years? Has it been more difficult, less difficult? Is it just different for founders of earlier startups looking to fundraise that seed round or Series A, in 2019 compared to a decade ago?
So there's a ton more capital out there. That's what we talk about all the time. So there's dorm room fund where they're taking bets on college students. There's like micro VCs. So about 10 years ago, we probably had more micro VCs come out, which is like 2 to 5 million. I'm seeing a lot less of that. And it's mainly, I think, because of the proliferation of what we call scout programs. So scout programs are basically ways that like top tier companies kind of look for great companies. So they'll ask founders of their portfolio networks to recommend people, and they actually give them spending cash, or what we call check writing ability, at like 100K, anywhere from 25K to 100K, and they're able to write checks into these founders. It's a way, because usually these venture funds are only several partners large, and so they don't have that many people to keep on looking for finding these incredible companies to invest in. So there's certainly a lot of crowding of like a lot of sources of capital. Republic is one of them. You're not the only crowdfunding platform out there either. So there's a lot of quote unquote sources of capital. Getting it is a totally different story though. On the flip side, and this might be something that Patrick might be able to talk to a little bit more, is I'm finding that there's some founders, I'll be honest, who are just like, I don't want VC money. I want more control. I want to do what Grasshopper did.
Oh, I think we lost Holly for just a few seconds there.
And there are some that are turning down VC capital money and saying like, I'm sorry, I don't really want your money. On the bootstrap side, I think that there's a lot more founders that are turning down bootstrap money. Can you hear me now? Probably not.
Yeah, we can hear you fine. That makes a lot of sense. And Patrick, if you don't mind, touch on that. And also, I would love to take a question from one of the attendees as well. But first, Patrick, would you mind, shedding some light on your personal perspective on taking VC money versus just, if you can, be able to finance it and retain full control over an operation?
Sure. My thought is, again, if you go back to the poker analogy, is the tight aggressive. So once you've found product market fit, then you raise money. And I think a lot of it just goes to like how big you want to get. I think it'd be very hard to build Uber without, significant funding, without venture funding. So if you're the right kind of business where it makes sense to be raising venture capital, I generally think it's better to do that. Like once you found product market fit, raise money, get big. But until you found product market fit, raise very little, raise a seed, if anything, and just focus on trying to get to that point. So I think it's fine to raise if it's the right business and you found product market fit. I actually think that's the correct strategy for the most part.
And certain business models would just be too expensive for most people to bootstrap, right? If you're trying to build out a biotech product, or a cure for cancer or some recipe thereof, that probably just the R&D cost alone would require some institutional or substantial backing rather than just out of someone's personal saving.
Yes, I mean, there are ones that definitely require more funding and potentially more funding in the beginning. So, but even in that situation, even if it's biotech, one thing, if I was going to do that and I was just starting out, is, try and hit up some universities and find some people who are researchers and experts in that field. Spend your effort trying to get some of them on. They probably already have spent years or decades in, researching and writing papers and all that kind of stuff. And that's at least one way to kind of, it's not exactly product market fit, but they at least, give you something that's like, makes you have more expertise in that space. And potentially some of the research may have already proven some kernel of product market fit that you can then use to raise money.
Yep, that's a great point. One of the questions that came in is that, and I quote, "My vision is to expand a single location jewelry repair, custom design, custom engraving shop into a nationwide franchise. How should I focus expansion, and should I look for outside funding or just put profits toward slow expansion?" If both of you can share your perspective, would be much appreciated.
Do you want me to go, Patrick, or do you want to go?
Yeah, you can go ahead.
Okay, so I think me and Patrick might have similar. So we have a similar problem with a lot of our friends who have something working and it's a kernel of something, but they don't really have product market fit before expanding. So our biggest thing, or my biggest thing, would be to try to saturate and get one location working really well. But just because you have one location working really well, that doesn't make you a franchise or even franchisable. I will throw this out there. Just take this with a grain of salt because I've never done franchising before. But what I would do is try to put profits into opening up 2 to 3 very good stores, and to almost be the franchise yourself to see if it's even franchisable. Because changing into a franchise model, you'll need to practice a couple of things, which is multi-store, multi-this. And then I would probably have I would take the profits and move them into your next location. Right now, I think you only have 1. I would try to expand it into 2 or 3. Maybe my third one, I would give it to somebody else and have them be the franchise owner, because the franchise business model is also very different economics, to see if it would end up working very well for the franchise owner if they would be incentivized. So that's what I would do.
Amazing. Patrick, do you have anything to add?
Not really. I think Holly covered it. I mean, main thing is, make sure you have one store working really well. And I agree. Try and expand it to a couple more, mainly to learn about how you would actually, because if you're going to franchise it, you need to understand how do you scale this to something larger? How do you handle multiple locations? What is the right place to put your store, etc. So you probably want to go through a couple of those steps. And once you have a couple stores under your belt, then you probably have a better idea of if this is something that can be franchised or not.
That makes sense. One of the questions is, if the company fails, what happens to the injected funds? And I can just take that one, which is generally, obviously, if the company goes belly up, then investors and founders would be a total loss. Let's say if there's enough money from selling assets, but not enough to pay back all of the debt or the investment, then it's just in the relevant priority of the investor or the debtors. First, you pay out, a typical vendor. And if you owe that vendor money, that would go out first. Then it would go to pay back investors for the most part, and founders and equity employees and team members. Only if, after everyone has been satisfied that those people would receive any leftover money. Obviously, there are nuances, and investment terms can be structured differently, but that's the typical waterfall. Did either one of you, Patrick and Holly, consider a bank loan in launching or building any of your businesses, whether it's Kabam or Rotten Tomatoes or the other ones that you've built before that, or government programs that perhaps support entrepreneurs in certain cities or that are considered minority or underserved?
My second company, we got a 30,000 loan from my co-founder's uncle and my mom. So it wasn't a bank loan, but it was essentially very similar. It had interest, and we paid it back over time. Never went the government route, but I see a lot of startups at early stage, especially if they're research oriented, that will get grants from government or universities or other programs.
So we did, our first money in was basically on a note, and it was called a convertible note. So basically it was a loan at a very, very low interest that converted into future equity. If not, like, we would try to pay back the loan. Currently, we've now moved much more closer to what we call SAFEs, which is a simple agreement for future equity. If you go on Y Combinator's website, there's templates there. You can feel free to use it. They pioneered this. And I will put in a plug for, so I'll put in a plug later for YC, but like, you can feel free to use their templates on it. And those are incredibly founder friendly because they don't put any stress onto your company.
That makes a lot of sense. Thank you so much. I think we're just about to run up to 3 p.m. here on the East Coast. I have just a couple of questions left. Both of you are sought after as angel investor or for the institution with which you're affiliated. What are 3 things in turn that you're looking for when someone pitches you for an investment into his or her startup? Holly, if you don't mind, go first.
Sure. So if I put on, like, putting my thing as a VC hat, a little bit less as an angel, a VC hat usually tends to look for, one of the things I tell founders is you need like you want the investor to leave with the word, this is inevitable. It's inevitable that the market is going to be huge. It's inevitable that the solution is something that these people will want, and there's a lot of people that will want it. There's going to be a lot of people that are going to pay the money, and you're the team to build the solution. So it's something that's like incredibly inevitable. Now on the more tactical level, if we're looking at say like you're applying for the Y Combinator program, which we take open applications, you could just go into their website. We're taking ones for the summer batch. We look for a strong founding team, like if it's early stage, that they've been working together for a while. We look for somebody who has a technical co-founder. What Patrick's saying is so true. You need a technical co-founder if you're going to build a tech company, and it's going to be a core competency. We look for, those are basically the 2 things that we look for, along with inevitability. Now, there's certain places where for people who've gotten into the YC program, there are times where it's a little bit different, where we have solo founders, maybe they've shown a ton of traction, or we've taken non-technical founders and they've sold, like they just have a ton of traction somewhere else. So it's usually somewhere where the buckets are different, or sometimes we've taken people at the idea phase and it's just pretty clear that this will happen and these are the people to tackle this.
Amazing, super helpful. How about you, Patrick? What are your lens as an angel investor?
I mean, for me, the number one thing, as I mentioned in my talk, is product market fit. Do you have something that people actually want, that you can prove that people want? If there was 2 other things, I would say after that, team. Especially do you have a technical co-founder if you are a tech company? And I would look at the idea as well. But really, the most important thing by far is product market fit.
I can't agree more. And I've learned so much from the insight and perspectives and advice and tips that you've shared. I'm sure that I'm not the only one who wonder if you usually take on a company as an advisor, as a mentor. What would compel you to, what type of companies, what type of founders would compel you to consider spending your bandwidth and join the team as an advisor?
For me, I generally say, like, my advice is free. If people reach out to me on LinkedIn, add me. I don't mind, doing a couple emails or a call or a coffee if they're local. As far as becoming more of a formal advisor, that's usually if they want to attach my name onto their thing, if they want me to make intros to investors and stuff. In that situation, it has to be the right fit. They generally have to be kind of at a certain level of progress, and that would take equity in that situation. So I do it. I tend to prefer consumer in the intersection of technology and entertainment.
How about you, Holly? And I was told that the webinar may automatically shut down at 3. So if you don't mind sharing quickly, and then just thank you so much for everyone for joining us today. You can find all 3 of us on social media.
Yeah, no problem. Mine's actually very similar to Patrick. So usually I'm pretty open, but sometimes my time is very much more finite. So usually I'm like, oh, if you want my time, apply to YC. But once you put my reputation on something, there has to be a good match, experience-wise, as well as interest and kind of working together.
Wonderful. Thank you so much for taking the time to, again, share your wisdom. I'm sure everyone on the call, and myself included, really, really appreciate it. Hope to see all of you on a future call hosted by USPAACC. Bye,
Thank
everyone.
you.
Great. Thank you. And bye.
Hi.
Hello?
Hey,
Hello?
Patrick, are you still there?
Yeah, I think we lost Kendrick.
I guess it's still on live. Oh, I ran out of time, but I was going to give them their email address. How long are you in town for, Patrick? How long are you in the Bay Area for?
I leave on next Thursday down